Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. I have my esteemed, trusted co-host with me, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally right here in Barrington. And we are fiduciaries. And as an independent family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up.
Yeah, quit buying everything, especially my Jersey Mikes. All right. Of course, we want to take a moment, just say hi to all of our clients who are listening today. We, of course, really appreciate the trust you placed in us, and we love every one of you. And I think we have a great show planned for today. So what we want to talk about today, we've got a couple of important topics. So one, as we've talked about for quite a while now, AI has been driving the markets for a long time, but maybe it's no longer that tailwind we've expected for the markets, and it could potentially be a headwind. And then we also want to say what is an equity risk premium? What does it mean? And is that a warning sign for stocks? And then after that, we want to do another segment where we focus on charitable giving. One specific tool that can be a huge benefit for you and your charity is something called a Charitable Remainder Trust. We're going to talk about what that is and some of the powerful benefits when you use it.
You don't want to miss that. But before we start, as usual, we encourage you to subscribe to our YouTube channel on moneyhourradio.com, where you can listen to this week's episode along with our previous one. As always, like and subscribe. That's the magic 2 words. You can also subscribe, please, to our weekly economic newsletter. It's called the 5-Minute Market Brief. It's succinct, informative, easy to read, lets you have a really good idea of what we're seeing that week and what we're thinking. And then lastly, if you are on BN Wealth, please follow our social media pages on Facebook and Instagram. All right, man, let's get into it.
All right. Well, if you really look at the market, you analyze it, you look under the hood, which is a big part of what we do, you're going to notice something very important. And for the first time in maybe like 3 years, AI is no longer functioning as an unquestioned, guaranteed tailwind for the equity markets. Instead, it's become maybe a bigger debate as to concerns about the return on investment for this AI spending by the major tech firms and potentially AI disruption of various sectors. And really, we've seen that pressure stocks recently. And even if you go back into November. So if we look back, the early stages of the AI driven rally, the market operated under a very, very simple assumption, which is more AI spending means stronger future earnings, which justified higher valuations. And that dynamic powered stocks to surge all across specific areas like large cap, technology, and AI related names. And people believed universally AI was going to boost productivity and increase corporate profits.
Well, fast forward to now, and things have changed, and investors are really asking 3 very tough questions. First one, are all this massive capital expenditures actually translating into profits? Number 2, is this spending sustainable at these current levels? And number 3, will AI enhance business models, or will it disrupt them and put a bunch of companies and people out of work? And recent developments illustrate how concerns about OpenAI's spending commitments, competition from Google's Gemini platform, and broader industry disruptions have altered the tone. And the bottom line is the issue is now about how fast profits can start to be realized, and also which companies are going to benefit the most and which companies are going to be left behind. So the tide is no longer lifting all ships anymore.
Yeah, and for these reasons, tech and specifically these AI related companies have stalled in the market the last few months. And many of the non tech areas of the market have gone up during that same period of time, including small caps and mid caps. Now, this could be a short term phenomenon, maybe taking a breather, and it really could be too soon to tell. It reminds me a little bit of early 2021 after the 2020 rush of tech. And then, of course, it came back. So you never know. And we're not here to make predictions about where to invest, but we look at the data and we react accordingly. And I think, like a famous investor, Yogi Berra, once said, it's tough to make predictions, especially about the future.
That's one of my favorite ones that he says. All right, let's switch it up. So, talking about things that are a little concerning for the market right now. One of them is the equity risk premium, and it could be signaling some warnings coming up here. And the difference between the earnings yield of stocks and the 10-year Treasury yield is called the equity risk premium. And essentially, what it means is how much extra return are investors receiving for taking on additional risk of owning stocks instead of just putting that money in risk-free government bonds. And right now, the earnings yield on the S&P is currently around 4.24%, while the 10-year yield on the Treasury is sitting at 4.17%, meaning right now the equity risk premium is just a mere 7 basis points. So, in practical terms, stocks are offering almost no additional compensation relative to the Treasuries for all of that added volatility and risk.
Yeah, it's always a little nerve wracking when we see it get this close, and it doesn't automatically mean we're going to see a big downturn, but it does mean valuations are demanding and earnings growth must deliver. And really, you start saying, okay, with it this close, there's no margin for disappointment. And so going forward, we're going to really be watching companies and earnings and all of the valuations. And that means selection and timing has become much more critical than just throwing a dart and you can hit anything and it'll go up. That's why we analyze these trends so closely, because it does affect how we invest for our clients.
And that equity risk premium that we are just talking about, in a normal time frame, you want that to be around at least 2%, so that you're getting an extra 2% at least for the risk you're taking of being in stocks versus bonds. So when they're flat, that's not a good sign. But you know how you were talking, Matt, about selection and timing and why we follow these and analyze the trends so closely? Because like you said, it affects how we invest. We don't just sit on positions and just ride things out. In our advance and protect models that we actively manage for our clients, we move our allocations towards the areas in the market with momentum and strength while we try to avoid areas of continued weakness. And as the trend changes, so does our allocations. Hey, does your advisor do that? Probably not. And while the market has been in an uptrend, guess what? We have not taken our foot off the gas. In fact, in some of our more growth-oriented models, we are pedal to the metal, 100% on equities, and have been for, frankly, many months. And because of that, we had a fantastic year last year in 2025 of making money for our clients. And in fact, even this year, we're off to a really good start.
Yeah. Now, the critical thing here, Ben, and you know this, but everybody in Radio Land, we're not 100% equities or maximum equities all the time. We actively monitor our investment positions every day. And if the overall market conditions do deteriorate, we'll do something about it. We'll get defensive. We'll sell out of the stock market. We'll go heavy into bonds or cash while we wait for things to improve. And it gets bad enough, we'll literally get 100% out of the market if the conditions warrant it. And we don't believe in riding these potential market crashes all the way down to the bottom and just sitting back watching your money dissipate. We feel, especially if you're in retirement, it's paramount to have a disciplined sell strategy to exit the stock market and protect your money if the risk gets too high. And the best time for you out there to go ahead and find one of these exit strategies or learn more about one is before you need it. while things are still fine in the market and not after the crash and it's too late and you're saying, I wish I would have done something. So I'll ask you, do you have a defensive plan to help protect your money from a potential market crash? We feel you should.
Matt, you know what's interesting is a lot of times on our show, we talk about short term and medium term risks. How about a long term risk that people haven't been talking about, or maybe you have? Ever heard of the national debt? 38 trillion with no end in sight. That can't end good if that keeps continuing. So part of our process to help protect against major things that could come as well. But if our investment philosophy resonates with you and you're looking to have your money managed like that, please reach out to us and schedule a complimentary consultation. We'll go over your current financial situation and your goals. If we can help you, that's great. And if we can't, that's okay too. We can't help everybody. We'll still part as friends. So to explore becoming a client, please reach out to us online at bnwealth.com or call our office at 847-780-2980. All right, do not go away because once we come back from break, we're going to talk about how a charitable remainder trust can benefit both you and your charity. Don't go anywhere.
Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I've got with me my esteemed and trusted co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm. We're located right here in Barrington. We're local, we're independent, and we're here to serve the greater Chicagoland area. And of course, we value giving back and trying to make our community a better place. And that's why we've launched our charitable arm of our company, BN Giving. And it's a way for us to invest in your purpose with you.
Here's how it works. If you become one of our clients and you're a faithful tither or a giver to a charity, as long as it's a qualified 501c3, each year we will match your donation up to 10% of the management fee that you pay us. And as our firm grows, so does the collective positive impact that we can have. It's such a neat concept. It's unique to our firm. And by the way, if you're not a regular giver, that's okay too. Most people aren't. We would, of course, still be honored to work with you. But to explore how you can join our BN Giving community by becoming a client, please reach out to us online, bnwealth.com, or call our office at 847-780-2980. All right, let's get into it, Matt.
Yeah, and we really wanted to talk about these charitable remainder trusts. And Ben, I had a person who was investigating our services. They came in to speak with me just this last week. And she had a foundation that she had established for giving overseas. It was a fantastic way for her to give back after earning an inheritance. And she had a donor advised fund, and she had developed this foundation and had done all these great things for charitable giving, but had never heard of or utilized a charitable remainder trust. And she needed income and she needed some of these things. And this can be a good solution. We're going to talk about diving into one of these really wonderful estate planning tools. And maybe it sounds a little boring, but it's not boring once you realize it can help you save taxes while you still help your favorite church or charity. And yes, we're talking about the very elegant Charitable Remainder Trust, or us cool kids in the industry like to call it the CRT.
That's right. We'd be like, hey, how's your CRT doing?
Good, man. How's your CRT? All right, maybe it's not that cool, but
Correct.
Don't panic. Don't change the episode. Stay with us. This is one of those strategies that really does sound like you need a law degree and a calculator to get this all figured out. But we're going to really simplify it and explain it in a very understandable way.
No doubt. So first of all, what is a charitable remainder trust? CRT, we'll shorten it, is actually an irrevocable estate planning vehicle that allows charitably inclined people to, one, convert highly appreciated assets into a stream of income, two, get immediate tax deductions, and then three, ultimately, at a certain future time, the assets in the trust go to benefiting a qualified charity or church of your choice. And for all you nerds out there, It's technically found under IRS code section 664. And here's the basic idea. You take an appreciated asset, maybe some stock you bought years ago for peanuts that's now worth a fortune, or maybe a rental property that's appreciated like crazy. And instead of selling it and handling a big chunk to the IRS and capital gains taxes, you actually transfer it into this trust.
All right, so you transferred it, but now here's the magic behind it. The trust itself is tax exempt because the assets are eventually going to go to a charity. So inside that trust, it can sell those assets, whether it's the rental property or the highly appreciated stock, and it will not trigger any capital gains. There's no giant tax bill at the moment of sale. And then the beautiful thing is you take those proceeds, you reinvest that into some sort of a portfolio in the trust, and all the future growth is also tax free.
And it's got so many benefits. And let's talk about them. I'm going to go through a few of them. So, first, you get immediate tax deductions based on the present value of the remainder interest that will ultimately go to the charity. So the IRS basically says, we see that you're eventually going to be giving money to charity. Fine, here's a partial deduction now. Thank you, IRS. Number two, you get income. So the CRT pays you, or whoever you name, an income stream for life or for a set number of years. And then after that period ends, whatever is left in the trust ultimately goes to the charity you've chosen.
Yeah, it's great for people who need income, but ultimately want money to go to a charity. And when you're doing this CRT setup, you're also looking at opportunities to do an estate tax reduction. So you're taking assets that are in your name or your estate, you're putting them in the CRT, and they're removed from your taxable estate. And that's less for the IRS to potentially tax later when you pass, right? There's not going to be this estate tax or death tax on that money. And that's more for your heirs and your charity. And there is this philanthropic legacy because it's going to enable donors to make a significant future gift to a charity. Really, that is something that is important to you. It supports your cause, but you're still getting some of these financial benefits during your lifetime.
No doubt. And as we were talking about the two different ways to get income from this charitable remainder trust, well, first, one way is called the Charitable Remainder Annuity Trust, or CRAT for short. And this one pays you a fixed dollar amount every year. So think of it as a steady paycheck. It's predictable, reliable, kind of like the Volvo of trusts. Okay. And then
Are
the other
Volvos
way to
still
get
the
income,
car?
it's dependable. Nice family car,
All right.
But then, okay, so here's the Ferrari. But then there's the Charitable Remainder Unit Trust, or the CRUT. This one pays you a fixed percentage of the trust's value each year, like maybe 5% or so. So if the investments grow, so does your income. However, if the market dips, well, you may have to go on a little diet since your income might dip as well. But so essentially, you get income now, you get tax deductions up front, and you get a charitable legacy later. So it's like having your cake, eating it, and then donating the crumbs to a good cause. Actually, just kidding about the crumbs. What's interesting is if the account is managed right, so the assets are in that portfolio, hopefully in the CRT, and it's managed by people like us, well, guess what? It could actually grow to a significant amount despite the income coming out.
Yeah, and a lot of times the formulas they use for like the the CRAT for that steady paycheck, the plan is a lot of that money is going to go to the charity. You're not going to get a gigantic, income stream. So there should be some money that still goes to your charity. It's not just crumbs, Ben. Now, they're not all sunshine and rainbows. There's a few things you got to be aware of. One, they're irrevocable. So once those assets go in, you're not able to take them back all out. There's no do-overs. It's almost like getting a bad tattoo. You're not going to be able to fix it. And there's complexity there. You're going to need an attorney. You're possibly going to need a CPA. You're going to need an investment advisor. There's going to be some situations that you're going to have to deal with professionals. This is not a do-it-yourself YouTube tutorial situation.
What? You can't go
And
to
third,
YouTube University?
I love YouTube University. I use it all the time. There's a few times I've regretted it.
No doubt.
And then third, these income distributions you're getting are taxed. So yes, the trust can sell assets without any kind of immediate tax, but when you receive payments each year, there is a tiered system for how they're taxed. Some of it's ordinary income, some of it's capital gains. It depends. IRS is always going to get invited to the party eventually.
So here's the bottom line. A CRT is ideal for someone who is first charitably inclined, also owns highly appreciated assets, wants tax deductions, wants income, and likes the idea of turning a tax problem into a charitable legacy plan. So if that's you, guess what? A CRT can be an incredibly elegant tool. And if not, that's okay too. There are plenty of other letters in the tax alphabet that might benefit you. And of course, as with any financial planning, investing, tax, or estate planning strategy, it's essential to work with qualified professionals who understand these concepts and, of course, can tailor them to your situation. Usually, a good financial planner like us, we're the quarterback of the plan, and we help coordinate it with your other professionals like your attorneys or CPAs.
Yeah, and where you need this quarterback is because as a financial planner, we're going to look at how all of these areas integrate together. Your estate plan, your tax planning, your investment plan, all of them coming together to work as one important area and unit for your benefit. And so if you're out there and you're like, well, do I need a good financial planner? Do I need someone who's going to put my own interests first? Am I going to work with somebody who knows all of these ways to help benefit my long-term planning strategies? Well, we'd be honored if you gave us an opportunity to talk with you about this. You know, if our investment, our financial planning philosophy resonates with you, please reach out. We'd love to set up a complimentary consultation. We'll spend some time going over your current financial situation, your goals. We'll do a free financial checkup where we analyze your insurance, your taxes, your estate plan, your investments. And if things look good, great. You'll get some peace of mind. And if there are holes, you'll at least know the areas you need to fix them. And many people have never had someone look at all of these areas in their financial life. And if we can help you, great. If not, we'll still part friends. So I implore you, reach out, go online at bnwealth.com or call our office at 847-780-2980, and we'd love to chat. Anyway, we're running out of time. God bless you, and we'll see you all next week.
Take care, everyone.